So hello again. Us at CEED are very excited about our Ask the Expert event series. Before we get started, I just want to acknowledge that we are in Mi'kmaq, the ancestral and unceded territory of the Mi'kmaq people. For those of you who may not be very familiar with CEED, it is the Center for Entrepreneurship, Education, and Development. We are a nonprofit organization that offers a wide variety of programs and funding that supports local entrepreneurs. Our Ask the Expert series occurs on the last Thursday of every month, where experts in various fields volunteer their time to reinvest their knowledge and skills into entrepreneurs within our networks and community. Oh, great. Perfect. I would like to extend a humongous thank you to Stephanie Folahan, CEO of Premier Accounting and Tax Incorporated, for being here with us today. Stephanie is a highly experienced accounting professional with over 10 years of experience in the field. Her expertise lies in financial reporting, budgeting, and projecting in all things small business. Stephanie is passionate about her work and always strives to provide the highest quality of service to her clients. Today, Stephanie will be presenting on the topic of small business taxes. This session will be recorded, which we will be sharing after the workshop along with the slides. There will be a brief Q&A session at the end, but please feel free to share any questions in the chat throughout the workshop. Stephanie, we are extremely appreciative of your dedication to being involved and supporting this community. We love when leaders like you come and inspire other people. So without further ado, I'll hand it over to you.
Thank you. Good afternoon, everyone. How's everybody? So hard on Zoom, right? The interaction, like no mics on. You're like, I'm good. I don't really know. I will ask, and I don't know if it's like CEED rules or not, just as a presenter in general, it's way easier to present when everyone's camera is on versus the black screens. So my preference is absolutely that you have your camera on and we can engage. I know that can be a little bit, nerve-wracking if you haven't been in this setting before, or, you haven't been in a classroom in a long time, but I promise I'll be gentle. I won't hit you with any trick questions to embarrass you. You can hit me with the trick questions, it's all good. But I absolutely want you to feel comfortable, and I want to be comfortable looking at your beautiful faces the whole time we're here this afternoon. So before I hop in, I would love to just find out how many business owners are in the room. Just show of hands, or if you know how to use Zoom, the emojis. Okay, all right, very good. Okay, so most of the room. And who's currently going through the SEB program at CEED? Just a couple? Okay, all right, very good. All right, so I'm gonna just jump right in. I've got some slides prepared. At any point, unmute your mic, hop in, ask a question. I don't love hearing myself talk for a full hour straight, but I can and will do it. But don't wait, if you have a question now, don't wait till 2 o'clock to ask when you've forgotten maybe what the context of your question was or what exactly it was. So, it's not a huge group that we don't have to worry about. Will we be able to get back on track if we rabbit hole on some topics? I'm here to deliver a tax conversation about your businesses. So whatever it is that you need, that's what I want to give you. So let me bring up the slides. Hi, Rick.
Hey, how are you?
Great. How are you?
Oh, just terrific.
Oh, that's good. Good. Did we lose Kim? Yeah, I think we did. Anyways, okay. Slides. All right, so I'm going to give you a little bit about myself. I appreciate Caitlin with the intro there. I think it's important to know that I am a seedling. So I went through the CEED program in 2018, 2019. In 2017, I had just left my job. I was there for 7 years prior to leaving the job. And I like to brag a little bit here when I do this part of my intro, because when I left, it took 3 people to fill my position. So that was pretty cool to leave on a note like that. I had about 6 months severance upon leaving that job to kind of decide what I wanted to do next with my life. And I knew towards the end of that job that I wasn't really built to be an employee anywhere. I was comfortable with risk. I wanted to jump in, I wanted to do something a little bit bigger, and I wanted to be in control of my earnings, the effort I put into the work. I wanted the return to match. So I went for it. So I joined the SEB program at CEED. I have a funny relationship with them starting out because I was definitely skeptical. I was hard on Paul and Craig. I'm very numbers driven. I wanted to know everything about every business that had ever gone through. And they really took the time to teach me that, it doesn't matter what resources I use or what program I go through or what course I take, my entire entrepreneurship journey is ultimately on me. And I hope that in your entrepreneurship journeys, you're kind of there too, because ultimately we are the only people that can control the outcomes. Doesn't matter, what's going on around you. I also learned that, the journey itself is one of the most rewarding things you'll ever do, but also a little bit lonely along the way. So you got to figure out that balance. I love that piece of it. I love the hunt. I always call it chasing clients. I'm absolutely meant to be an entrepreneur. Fast forward to June 1st, 2023, my business has turned 4 and we're worth well over $500,000 in just those 4 short years. So not only do I know a little bit about tax, I know a lot about the journey that you're on and the things you're going through and the long nights and long days and stresses. And, it seems like everything's coming at you all the time. That never changes. You got to learn to embrace it and find out a way to make that work for you. Let's jump in. Let's talk some tax. Please don't leave. Scary topic, right? You can do some research. You can go on Google. You can go on YouTube. It's really hard to piece the information together in a way that makes sense so that I know where to start and I know exactly where to end up. I went on ChatGPT a couple of days ago to get some tax information for something I wanted to present, and ChatGPT gave me everything wrong. Luckily, I know enough about tax to know that it was wrong. But if you're using, AI or Google or YouTube, whatever it is, to research, this really stressful, complex topic, and you don't know enough about it yourself to know if the information you're taking in is wrong, that makes it discouraging. So courses like this, webinars like this and other courses that are offered are a great place to get the foundation that you need to be able to, confidently understand this side of your business. I don't think anybody left as soon as we started talking a little tax. So here we go. So I'm not actually going to present on sales tax today. An hour is just not long enough. We're already 10 minutes in, but I don't like to make the assumption that everybody in the room knows the difference. And while some of us may say, how do you not know the difference? That's not fair to the person that doesn't know the difference. So income tax is the government's portion or their cut of your profit on your business earnings. So that can be a combination of your business earnings, employment income, and any other source of money coming in. The CRA gets a cut of that. We as business owners are responsible to remit that payment to CRA, whatever that amount is. At the end of the year, we've all probably done taxes at some point or other. Looks a little different when you're self-employed, but that is the main thing with income tax, is that it's the government's portion of your earnings. Sales tax in Nova Scotia is known as HST. It's not necessarily HST everywhere. There's a sales tax in Quebec. It's called PST, QST. There's the GST is the federal portion. So I'm not going to use the acronyms because they're different in every province, but mainly here in Nova Scotia, the provincial and federal portion is called HST. And it's the tax you have to charge on the goods and services or services that you sell. Can I just stop for 1 second? Is anybody in the room HST registered? Are we there yet in our journey? No, yes, a couple of us. All right. And are we finding that part stressful? Do you feel like you're always doing HST, or are you annual? Rick, you just registered.
Yeah, but previously I had a business. We were quarterly, and it was always it was always a pain in the butt. But
Okay.
But you get it done.
Because I'm not going to present on sales tax, I only stopped for a minute to say, before you register, if you remember anything I'm going to say about the sales tax piece, go annual or quarterly. Monthly, while it might sound great, the CRA person you call to register with might suggest it, you will feel like you're doing HST every day. You'll be like, oh my God, I just filed an HST, the next one is due. And it just seems like this never-ending cycle of filing HST. Quarterly is great because you can stay on top of it. It's a great way to not have this big surprise at the end of the year. annually. Sometimes I see it get away from us as small business owners. So we don't really know what to expect at the end of the year. And by waiting 12 months, normally that surprise is not at all pleasant. So quarterly, it's a little more manageable. So if I could lend that to you, that would be my advice around sales tax. Okay, so when I said the government's portion of your earnings, the profit is calculated as your sales minus your expenses. It's that simple. You pay tax on the number that is the result of those two calculations. And yes, I obviously break it down and make that sound really simple, but you're like, how do I get to those numbers? We'll get to a deductions list in a little bit, but I'm just going to give you a little bit more of the basis of income tax first. So, sorry, one more question before I go. Anybody incorporated? Oh, beautiful. Oh, you are, Rick. Okay.
Recently.
That's all right. Okay, very recently. Okay, so I'm going to generalize mainly sole proprietors, and I will hit a small portion of incorporated at the end. So as a sole proprietor, your personal tax and your business tax are combined. They are not two separate reports. They don't get filed, one in April and one in June. They go together on the same T1 general. They have different schedules for different sources of income. So let's say you work a job and you have a small business. You get a T4 from the job that goes on a T1 on the tax return. And then your self-employment income, so your own sales and your own expenses, both get reported on a T2125 form that calculates your business's income and then combines it with your other sources of income to determine your total income and what bracket you should be taxed at. You are allowed to deduct expenses. So as a small business, you absolutely can deduct expenses. And I would say that this is one of the biggest missed opportunities for small businesses that I meet in the first year, because they're coming to me at the end of the year. They're like, hey, I'm ready to get my taxes done. What do I need? And without question, they haven't kept everything that they could have deducted because they didn't know what they could deduct. The minute you go into business, you need to launch into learning what is deductible, because every dollar you fail to deduct, you pay tax on at your marginal tax rate. Marginal tax rate means your tax bracket. So not keeping the expenses, and when I get the opportunity to get in front of a room like this, I always say, if you take anything from this, you don't remember everything we're going to talk about in respect to the deductions, just keep everything. Let your accountant tell you what's not eligible. I would way rather have 3 extra Sobeys bags of receipts than none at all, because I hate to be the one to have to give you the bad news of, hey, you owe $12,000. That's a pretty big shocker, when maybe that bill could have been $7,000 had we kept track of these items or even just kept them. Net income after calculations. So your net income is exactly what that means. So net means after deductions. So after I've calculated all my expenses, after I've calculated all the credits or deductions that I'm eligible for as a Canadian resident on a basic tax return, I then pay tax on the net amount. Again, your personal income tax is a combination of all your sources of income. So that can be employment income, investment income, RSP income, self-employment income, contract income, anything that comes to you under your social insurance number, plus your small business income, would be all calculated on the same one tax return. None of it is separate from each other. Okay, and I did create, and I'll share that with you in a few minutes, a deductible expense sheet for you. And I want to highlight, because on the deductible expense, checklist, we don't usually put things that aren't deductible, meaning, I wouldn't want to confuse you with items that I get often people confused, or they are confused with, assuming that they are deductible. So one of those items is credit card payments. I often get a line item from people that say, you know, here's my vehicle expenses, here's my office expenses, here are my credit card payments. Your credit card payments are not an expense. The items you bought on your credit card can be deducted as an expense, but moving money from your business account to your business credit card is not considered an expense. So make sure that you're tracking everything from your bank account or your business credit card separately and equally as detailed, because the credit card payments themselves will not be deductible. And I find people miss that a lot in their expenses. Okay, so in addition to having to pay income tax as a small business, you're going to pay CPP, Canadian Pension Plan, for both yourself and the employer portion. So you get hit twice with this. This can be as much as $7,000. If you net $66,000, you're going to have a $7,000 CPP bill. Now that will be calculated into your regular tax bill. So you'll get a tax bill, let's say it's $17,000. The CPP will be within that. So you're not going to get a separate tax bill for CPP. But this one catches people off guard very often, that we have to pay because we're both considered the employee and employer. The CPP maxes out at around $3,500 a year. So I have to pay both of those portions. Not a pleasant payment to have to make. You do not have to pay EI, employment insurance. If you're in an SEB program right now, self-employment benefits program right now, enjoy your last round of employment insurance, because if your business doesn't work out, you don't get to collect EI the same way you would if you were laid off from a job. You got to make this work because EI is not an option. Tax deadlines. So this one's a little bit backwards. I get lots of questions about this. So the sole proprietor tax filing deadline is June 15th. So it just passed. We hopefully all filed our taxes on time and we're good to go. But the payment for that tax period was due April 30th. Logical question, how could I pay by April 30th if I don't know what I owe until June 15th? So the answer to that is don't wait until June 15th to find out. Do it in advance, or without question, unless you've made installment payments, you will owe interest between that period, the April 30th to June 15th period. Now, if you owe more than $3,000 for a single year, you will have to make installment payments. That basically summarizes as prepaid tax. So if I owe $3,000 on April 30th for 2022, I then have to pay $3,000 again before the end of 2023, because CRA is going to assume that I'm going to have the exact same tax situation at the end of the following year. They don't want self-employed people to have an advantage over anybody that has to pay taxes like an employee as they go. Every paycheck, CRA gets their cut of your earnings. So installments are a similar concept. They want the tax paid throughout the year. So in your first year of sole proprietor business, CRA doesn't know that you're operating. They don't know what the outcome's going to be. Nothing happens. Then on April 30th of the following year, you file your taxes, you get your tax bill, and then you get a letter from them a couple of days or weeks later, that says, thank you for your payment. Now we also want next year's taxes as well. So it's, if it's only the $3,000, then it's a $6,000 tax bill in about 6-7 months between when you file your taxes and the end of the year. Let's say that tax bill was $17,000. The exact same concept. You got to pay the 17 by April 30th, and you pay another 17 for the next period based on CRA's assumption of that will be your tax outcome for the next year. Installments are painful. They're not suggested. They are technically mandatory. If you don't make them, all I've ever seen happen is a penalty. I have seen penalties be 100% of exactly what the installment was supposed to be. So I've seen $1,000 installment required, and I've seen $1,000 penalty on that installment. The more you don't make the payments, the higher your penalty gets. But I've seen very small ones too. So, it is kind of what it is, but ideally you make those installments and you keep CRA happy. For deductions and credits, you still get, as a self-employed person, all of the same credits and deductions that you'd be eligible for if you were an employee. So the personal basic exemption amount, that first $14,000 or so of income that's not taxable, the age amount or the working amount. There are deductions and credits that you'll be eligible for specifically. Being self-employed doesn't make you ineligible for those. So there's no loss in credits as a result of being self-employed. And now if we're already kind of making you anxious about the tax chatting, all I would say here is continue to take these courses, push yourself to learn, go over this information again after we've had the end of our session. But still, I wouldn't wait until the end of the year to talk to a tax professional. I think you should get ahead of it and talk to someone. I think I have someone in the room who reached out to me already who wants to talk about tax before the end of the year. They want to talk over the summer to get ahead. So that's a great position to be in. All right, so tax planning. So this is exactly what I was segueing into, tax planning. So I can't tell you how many folks get this piece wrong. And what I mean by wrong is we assume, we hear tax planning, and I think people assume, investment strategy, more a little bit life planning, not necessarily approaching tax planning as planning for one of the largest expenses you will have in the year. For me personally, without question, it is definitely the largest expense I have. So I need to plan for a large chunk of the cash flow that's coming through my business as well as my personal accounts. Both have to be allocated to CRA. So I don't think I have more cash or more money available than I do. I tax plan all year round, and it's really important as a business owner to do that. It's tough and it's sad how many times I do a tax return at the end of the year and I tell someone, hey, you owe $17,000, and they don't have the $17,000. Then CRA is looking for installments. We're already 6 months into the year. The next round of taxes is coming due very quickly. It snowballs very fast and it can get away from you very quickly. So tax planning, understanding, hey, if I make $30,000, I will need to pay this much tax. If I make $60,000, will I need to pay this much tax? Having some concrete numbers will really help you with understanding and planning and avoiding those tax disasters that, sadly, I could tell you tons and tons of stories about. So let's, for tax planning, choosing the right business structure. So, whether we're sole proprietor or incorporating, as I think I saw only one person is incorporated in the room, so I'm not going to spend a whole lot of time on that. I'll give you a quick note. If you're going to do $100,000 in profit, not revenue, profit. So profit is sales minus expenses. After expenses, if you're going to have $100,000 in the bank, incorporate. You're going to save some tax. Before that, you'll likely, the way things are going in Nova Scotia, you need $100,000 income to make it here anyways. So you likely won't be leaving a ton of money in the bank at the end to make it worth saving the difference in the tax brackets. Keeping accurate records of your business expenses. So that's part of your tax planning strategy, is minimizing your profit. The lower your profit, the lower your tax bill. Obviously, we didn't get in this game to have, the lowest profit possible, but as it relates to tax, you definitely want to roll into there with the lowest number possible so that you pay CRA the least amount possible. Take advantage of all deductions and credits. So making sure all of what goes into running your business so that you can, in fact, claim everything that you need to. Understanding the rules for capital assets and depreciation. I probably get 15 phone calls the last couple of days before tax season, or sorry, before the year ends, from business owners saying, I have X amount of dollars in the bank. Should I go buy something big so I don't have to pay much tax? If you go buy a vehicle or a large piece of equipment for $80,000, you don't have an $80,000 expense. That item depreciates. You only get to expense a portion of that item at the end of the year. Oops, let me see. Somebody's up for me, the chat. 100K in sales or net profit, net profit. So in the chat, it says, it's just a question in respect to the incorporation comment that I made. So it's asking if I meant $100,000 in sales or $100,000 in net profit. And I absolutely meant $100,000 in net profit. Because if I have $100,000 in sales and $200,000 in expenses, I save nothing by having incorporated. So very good question. Thank you. Okay, so the capital assets, again, so if I make a really large purchase, it's not necessarily going to save me from the tax bill that the way I think it might. And on top of that, I'm also then going to have issues with my cash flow because I spent the $80,000 that probably should have went to CRA. Be strategic with the timing of income and expenses. I am huge for this. We don't, right around our year end in my business, large projects come my way. I'm like, yep, no problem. We're going to start that. My year end is May 31st. I'll start that on June 1st. I'm going to pay the tax no matter what, but I feel better about it paying it later. So I timed that income on large projects for after my year end. Don't wait until the end of the year to get the understanding of your tax position. So those tax surprise conversations, they're uncomfortable for you, they're stressful for you. And then your tax person is probably spending time consoling you rather than actually time teaching you and strategizing how not to get into that position. I have been told off more times than I can count, or I've had people cry and go away for 6 months and then call me back and say, yeah, file it. I guess it's right. Like there's a huge range of emotions that comes with the stress behind tax. And it's kind of one of those things you just have to rip the Band-Aid off and get comfortable with being uncomfortable so that you can learn enough to make sure you're set up so that you can stay in business. Because I also see lots of bankruptcies for businesses because of tax. So, let's not get there in the first place and get ahead of it. Always consult a professional. If you're feeling uncomfortable, you're feeling like this isn't making any sense, don't hit submit on your TurboTax return. If you have questions or you still don't understand exactly what you're looking at, pay the few dollars to sit down with a tax professional to really understand what's going in. It will be worth the money. And even if you have an accountant or a tax professional, you should know as much about your numbers as they do. I didn't say you have to know how to calculate them or how they got there necessarily, but understanding what your sales were for the year, what your total expenses were. Did we claim a vehicle? How much usage was the vehicle? Why do I owe this much money? Understanding that piece of it helps you make better decisions and keep better records to avoid, a terrible tax outcome. And keeping great records doesn't mean you're not going to pay tax, right? You're still going to pay tax. If you're making a profit, you're going to pay tax. So just be mindful that doing all these great things doesn't necessarily equal no tax. It equals the best tax position your business can be in by keeping, good records and tax planning and strategizing. Marginal tax rates, tax brackets. Have we heard of tax brackets before? Anybody? Must have heard of tax brackets, right? Have you ever heard anybody say, I got a raise and now I make less money? Yeah, absolutely not true. Impossible even. You might make less money per hour or the job might be less profitable, but there's no situation in which you're 100% taxed, which would have to almost happen for that to make any sense. So a couple of notes about marginal tax rates, and I probably bounce back and forth between marginal tax rates and tax brackets. So more money is more money. If I get a raise, I got a raise, I'm going to make more money. That said, it might seem like less if the new portion of my raise is in a higher bracket. So let's say, I'll use a big number here because it's an easy bracket to mention. If I make $150,000, I now, at the 150 mark, between federal and provincial tax, have entered the highest bracket there is. It's just around 51%. Let's say for whatever reason, I'm going to take a part-time job working at Walmart on the weekends to make a couple extra bucks. I make $15 an hour there, which actually works out to $7.50 an hour at my tax bracket that's actually 50% because it's all my income together. Now, it's very unlikely I'm going to make $150K and then go be a greeter at Walmart. But the new money that I make on top of my 150, I need to make sure it's something I really want to do or that makes sense financially, because that after the 150, that money is very expensive. Half of it's gone right away. The tax system in Canada is self-assessing. So that means I report my own. I can hire someone to do it for me, but CRA takes it in good faith. And ultimately, the more money you make, the more you pay. So I start out at the low bracket and I work my way up the ladder. At each step, the money I make that falls within that bracket is taxed at that rate. So I'm going to go back to the $150,000. When I hit the $150,000 tax bracket, all of my income is not taxed at 150. Every portion of my income stays in the bracket it was in. So 0 to 15 is taxed at this. 15 to 29 is taxed at this rate, and so on, all the way up the ladder. So at no point does your new rate affect the income in the lower brackets as you go. It will simply be the income that falls in the new bracket. So again, more money is more money. You never clear less on your check after a raise. It's impossible. And then the cost of your decisions. So exactly the example that I explained, making 150K, taking on a little side gig, not understanding that you think you're working for X amount of dollars, but in fact, you might be working for significantly less. So being mindful of those marginal tax rates on your way up. So I'm not going to sit here and try to help you memorize the brackets. I don't even have them memorized. I use a tax software for this, but I'm going to give you a tax scenario that relates to the tax rates and tax brackets. So let's say in scenario 1, we've got a small business owner. His name's Rick. He owns a small painting company as a sole proprietor. In year 1, he has a net profit of $30,000. That means his sales minus his expenses equal $30,000. That's what he has left at the end of the year. Rick comes to get his taxes done, and his tax person's going to tell him, you have to pay. Well, they're going to give him the total bill. They won't necessarily break it down, but I'm going to break it down for you. In CPP, Rick will owe the employee portion and the employer portion of $3,021. He will pay $1,887 in federal tax and $1,380 in provincial tax. He will benefit from the credit of the Canada Workers Benefit. So it's a little credit for folks under certain income. So it will reduce his tax bill by $709. And he will pay on $30,000 living in Nova Scotia, $5,579.14. Scary, I know. So scenario 2, and sorry, just to clarify, this slide, when they're sent to you, is the federal brackets. So because we pay federal and provincial tax, it doesn't sound so bad, 15, 20, 26, 29, and 33%. These are just the federal. We add those to the provincial to get our true tax brackets as we go. So the next slide is a similar scenario. These are the provincial, Nova Scotia provincial tax rates here, as you can see. So let's say Rick has the same small business, the painting business, but he's also going to work a T4 job in the year. He's going to make $30,000 at the job and $30,000 painting. So he's doubled his income. You know, generally speaking, you might think, well, let's, double the income, double the tax. So I'm going to put away $11,000 for my taxes next year. Seems reasonable, except for the fact that Rick has hit 2 separate tax brackets on his way up the ladder. So now we have different issues. Rick is going to pay $3,420 in CPP. He's going to pay $6,567 in federal tax and $5,893 in provincial tax for a total of $15,880. So I've doubled my income, but almost tripled my tax. So without actually, having concrete numbers and doing the tax planning, a lot of folks do that. They kind of gauge it, do these estimates and guesstimates of what they owe. And I promise you, if Rick comes to me to get his taxes done this year, and this were his scenario, he would be very shocked and he would absolutely not be prepared for a $16,000 tax bill based on his $6,000 tax bill in the previous year.
Can I ask a question on this?
Yes, please.
Sorry, I couldn't find the raise the hand icon.
I can only see a couple anyway, so just do what you did.
Okay. Yeah, sorry, because I didn't mean to interrupt you.
No.
What I did find interesting with those 2 scenarios is in scenario 2, I did expect that the CPP would be much higher considering it's double the income.
Well,
it only went up very marginally.
That is so good, because the $30,000 of employment income, your boss handled the employer portion on the other side as an employee. You only have your CPP, you only have one portion of it. So we didn't add much income to the CPP.
Oh, okay.
As an employee, it's taken care of.
Right. Just so with the other numbers ratcheted up so much, I expected that CPP number to go up. But I guess what you're saying, to be correct, is although you didn't show it in that example, there would have been CPP deductions from the employer at the job that Rick was working.
Yes, but there are CPP expenses that would not be your responsibility as an employee.
Right.
That's why it didn't double, because in scenario 1, you're employer and employee. In scenario 2, we add the other portion of income where you are not the employer who covers the CPP.
Right. Excellent.
So you've maxed out.
Great. Thank you.
No problem. Just going to check the chat. I can see if brands are sending gift items, would those qualify as expenses on my end? So if brands, Charlene, is that you? If brands are sending you gift items, should those qualify? So how would it be an expense for you? Do you pay a portion? Can you clarify?
Yeah, because I've had some brands send out to me, for example, clothing. I did another event where I collaborated with this restaurant, and they gave me the receipt at the end. So it's free, but not technically free. So my question is that when it comes to doing the taxes, is that technically an expense on my end? Because even though it's gifted, it's not technically gifted. So that's my question. Right.
So if anything, if I'm understanding the relationship properly, I'm hearing that it's income, not an expense, because you're not paying the brand is paying you. So you have to assign a value of the gift received from the brand as that part of the relationship. So that one's complex, but just generally, high level speaking, depending on the value and how many of these and the specifics of the relationship, there probably should be a line item on your tax return for gifts received and how you're going to pay tax on them. Let's say they send you a car. CRA is going to want you to pay tax on the value of the car they sent you as in the form of a gift, because it's equal to cash to them.
Okay.
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 All right. Any other questions before I hop back in? Just so you know, I can only see like 4 of you when the slides are up. So I'm definitely not ignoring if your hand goes up. As I said, interrupt me at any point. Okay, so small business audit. This is the scariest part, right? Like you worry about doing everything right. Yes, I don't want to pay any tax. That part's stressful, but there's nothing more stressful than that 1-800-959-8281 phone number on your call, or the brown envelope in your mailbox that says, hey, we want to review this or this, or please send copies of this. You know, that part is stressful. So audits, you know, let's talk a little bit about how we get there. Being self-employed doesn't necessarily make you significantly more at risk for audit. You know, we have random selections. The industry that you work in, my industry's on there, so they obviously assume we know how to work the system, I guess. Real estate agents, doctors, cash businesses, construction, businesses or industries that they've been successful with their audits and finding money. Those are the types of industries they're going to continue to go after. If they go after 10 real estate agents and they find nothing, or they in fact find that perhaps they owe those taxpayers money, they're not going to keep digging. They're going to go where they think they can recoup money. So those industries are, you know, predetermined. CRA knows who they're looking for. There's lots of underground cash, you know, businesses, food trucks, restaurants in general, construction. You know, if you're paying someone cash, they're probably not reporting the income. CRA is looking for those things. So being self-employed doesn't necessarily make you more at risk. Red flags are absolutely, you know, filing late, filing amendments, discrepancies, errors on the return in general. Those are going to, you know, just scream to CRA, hey, look at me, like, you know, can't get this and this right. Maybe you should dig a little deeper because I probably have made more mistakes than you've found just at a high level review. Information matching. So CRA has access to all of our bank accounts, all of our payment solution processing reports. Anytime you sign up for a bank account in Canada, you sign a document in that says CRA can have access. So they are keeping an eye on our activities. So if I got $1 million in the bank and I report $50,000 of income on my business, I'm probably going to get a call or a review of some sort. Not filing. This one's kind of sad to me because, you know, I run into some folks that end up in the situation that I described earlier. They have a tax bill they didn't expect. They also now have to do installments, the prepaid tax situation. So they don't file. They just freak out and they don't file the returns. They kind of just think maybe if I don't file it, CRA will leave me alone. Then it snowballs into a couple of years. What's going to happen is CRA is going to send you a couple of letters demanding you to file. And then if you don't, they're just going to make up a tax return in a number that you owe on your behalf. And, you know, it's kind of hard to get out from underneath that. And likely you're going to have to be in some form of a review or audit. I have 5 audits on the go with CRA right now, and every single one of them stems from failure to file. So people just not filing their taxes. And then when they finally did file them, whether it be 3 or 4 years, maybe 7 years, every one of them got audited. CRA wants to know why you stopped filing, and they want to know in detail how much you owe them. So they feel strongly that there's money there, and that's the reason you stopped filing. Top 10 reasons to get audited and how to handle CRA. I have very simple advice on CRA. I'll give it to you in a minute. So inaccurate or incomplete reports or returns, claiming expenses or unsubstantiated business expenses. So CRA will take your bank statements for income, but they will not accept your bank statements for proof of expenses. Kind of a double standard there. They'll use that as it works for them. But the expenses, if you don't have the specific receipt and all the detailed information that's required to substantiate a specific expense deduction, you will have some problems. incorrect classification of employees as independent contractors. So there's a huge thing with independent contractors or subcontractors not filing or assuming that they're working for cash. You're claiming them as an expense, but they're not claiming the income on their taxes. You and that contractor probably both get audited as a result. Again, non-compliance. So if we don't file, we don't pay, they're going to likely want to audit us. Discrepancies, inadequate documentation, they find it once, they'd audit you, you don't have the receipts, you don't have the proof of everything you claim, very likely they're going to do subsequent years as well. Aggressive tax planning and strategies, so you're coloring outside of the lines a little bit. They don't like us to do that. Reporting personal expenses as business. They have a department of at least 60 folks in Ontario who are watching our social medias, making sure that our lifestyle matches what we're reporting on our taxes. So, be mindful of what you're putting out there, even if you're doing it just to look one way, things might actually be another. It could be a reason you get audited. And then random selection. So these are the top 10 reasons. And you see that none of them say because you're self-employed, but it absolutely, factors in if your record keeping isn't very good. Handling CRA. So if CRA calls you, they want to review something or they've got questions, I always recommend you do not answer their questions then and there. You cooperate and you ask what their questions are, and nobody has their books or their taxes memorized. So to try and jumble together an answer when you're nervous to begin with isn't in your best interest. Doesn't mean you're not going to answer truthfully, but you're going to answer accurately later after you've had the opportunity to review and actually pull the specific information they require. Anybody I've had that CRA has gotten them on the phone and they started spewing numbers or just nervously saying, whatever. I have had many situations that escalated and actually for no reason. So you can absolutely say, please send me a letter with the request of the information that you need, and I will be happy to provide it, or my accountant and I will provide it. You get 30 days for any requests of information, so you don't have to feel pressured to answer right then and there. No matter what, you're going to get off the phone and say, shoot, that wasn't what I meant, or I said that wrong, wasn't the right information. So don't do it. Just be calm, ask them what exactly they need, and you'll get it to them within the allotted time frame. Just in closing, I want to say that every tax situation is unique, is very, very different. My team and I laugh. We get calls often. We have this one guy that stands out. A year ago or so, he had called me and he said, can you please send me my friend's tax return because I'm going to file the same thing and I don't want to pay you. And I said, that's great that you don't want to pay me, but I have no idea how your friend's taxes would be the same as yours. But I am not going to send the information. You'll have to talk to your friend about however that's going to work. But just the foolishness that goes on around tax situations, for him to think that his tax situation would be identical to the tax return that we prepared for his friend who, worked, had a job, went to school. There were some very specific things. I'm not sure how he thought that was going to work out. It's not a good tax strategy. Understand your own situation, your own setup, all things considered, holistically what the best outcome for you is and how to get there with understanding your tax situation rather than running from it or being nervous and kind of ending up in a bad situation with taxes. I think that's my last slide. It is. Questions? Nobody? Rick, come on, you gotta have a question.
Well, okay, I got one, but it's a good one, and I don't want you to take too long to answer it.
Okay.
All right, so I'm going to kind of give you a little bit of a scenario, and just maybe if you can just try to answer it generally. We don't need to be real specific with the numbers.
Okay.
So here's kind of the example. So let's say you make $85,000 a year, as either it's on a T4 slip or let's say as a sole proprietor. So that's all taxable income versus $85,000 dividend income from a corporation. What's the bottom line tax differential going to look like?
Absolutely. So the $85,000 main differences will be a dividend does not have CPP. So $7,000 saved right there. Remember that not paying or contributing to CPP now affects the amount of CPP you get when you start collecting on the other end. So not contributing to it, but $7,000 is $7,000, as well as the dividend tax credit. So without question, claiming an $85,000 dividend versus $85,000 of self-employment income or T4 income, the dividend is cheaper, like a lot cheaper.
So that the second part to that question would be, would there be a point where let's say the income is 150,000, that you would say, okay, what would maximize the tax situation would be a dividend up to this amount, but then because at the end of the day, the benefits of the salary of the T4 is that you do pay EI, you do pay CPP, but you also get those benefits if you ever need them. Because if you
not EI
dividends, not EI,
not
but
EI.
but because I mean it's somewhere you. So
what's the happy medium, right?
Yeah, like maybe should the first 50,000 be dividends and everything after that take it as regular income, because the tax benefit of the dividend is no longer there's a law of diminished return.
Yes. So the CPP maximum contribution maxes out at $66,600 or so worth of employment income. Okay. So after that, there's no benefit to being on salary because you would have maxed out your CPP contribution and you are contributing to your future retirement plans. So if that would be, I would never take more than that. That's just my strategy. Doesn't mean it's wrong, but I'm then going to flip everything to a dividend. And in the first few years, I usually only took a dividend as well because I wanted to minimize my tax implications while I built some cash flow. So it's not necessarily a 25 here, 25 there. There's 0 point after 66,000 of T4 employee income for your corporation. You can only do that if you're incorporated. And then also if you're, depending on what you're trying to do, if you want to keep some cash in the bank, then you take the employment income all the way out of the equation and you only do T5 dividends. It's very specific, that one, Rick.
Right. Well, thank you very much. That was excellent. Your presentation was terrific. Are you taking new clients or are you full?
Depends. Did I see Ren? Was it Ren? I'm sorry, if I'm saying that wrong.
Yeah, I did have a question, but forgive me, I thought I was 10 minutes late. It turns out I was 40 minutes late. So I think any questions that I have can probably be answered once I watch the recording. So thank you for your patience, but I'll just save my questions until I actually see.
Are you sure? I totally don't mind.
Oh, really?
Go for it.
Okay, so I am a sole proprietor. I provide services, not necessarily a product. And I am concerned about HST, like how do I start calculating that because of the time limits. And then also, for example, I have a business account and things like that. So money is being put into the business account, but I also need to pay myself into my personal account. So to have records of that, and you said bank statements aren't really the greatest to show the CRA that things are true. So yeah, it's kind of a double.
Okay, I think I got it all though. Don't worry.
Okay.
So firstly, I will say I'll just hit the income. So you're selling, whatever it is, your service to your clients. They're paying you through whatever platform, e-transfer, Square, what have you, comes into the business account. You then e-transfer yourself half or whatever you've determined, your pay is for that project. That's going to be fine. The flow is perfect. There's going to be records of income into the business account and then an e-transfer history report from yourself from the business to yourself. CRA loves that separation. They don't love when we just use the business account for that income. And I did mention that CRA is good with bank statements for income, but they don't let you really use it for expenses. So they're going to say, yes, we see that flowing that way. That's good. So you're very likely more than fine. You know, I transfer myself my own dividend once a month too, and I've been doing it for 5 years. So we do that with lots of clients. The HST piece. So you're saying, I think I heard when do I and how a little bit in there.
Yeah, because I know it's, you know, over 30,000, but it's like, but only if within the last 3 months or the quarter, except when Mercury is, you know, it's just like very.
Yeah, no, that's exactly. So it's a 12 consecutive month period of 30K. So it doesn't mean from January 1st to December 31st that I made 30K. Maybe I went from March to February, and in those 12 consecutive months, I made the 30K. So as soon as you hit 30K, or even if you're close, just do it. I know that, like, you know, we're not all bookkeepers and it's easy for me to say, just do it. It's so simple. But when you're in business for a couple of years and now you're getting momentum and you want to change things, you have all these clients you haven't been charging HST, and now you're going to charge them HST. They're not going to like that. So there's that piece, because the change, you likely are going to eat that in a form of inclusive of HST in your price now. And your new clients will have to pay HST on top of the regular price. But if you truly are going to make a go at this, and this is going to be a full-time gig, in Nova Scotia, you need more than $30,000 to live now. So without question, if I'm going to work this as my only job, I'm hitting the 30K, I'm going to register, I'm going to be professional, I'm going to, you know, charge my clients the way I'm supposed to. And I would absolutely go for it. I would, without question. I teach this, so I have courses on this stuff. They're funded from the federal government. Sorry for the plug, CEED. Up to myself, I absolutely think that getting ahead of that HST stuff, because it is intricate, but the long and short of it is $30,000, charge HST, keep it aside, don't put it in your regular income account, and have it ready to go quarterly or annually to CRA.
Okay, great. Thank you so much. That was really helpful.
No problem. Any other questions?
I have a question.
Sure.
So I want to admit that I am so over my head right now. My situation is that I actually I'm a client of community services and on CPP disability.
Okay.
And so those two organizations have very specific rules over how much income you're allowed to have before they kick you off those services.
Mm-hmm.
And so right now I'm working in the sweet spot. And so you were in your scenario today, you were talking 150,000. I'm like, man, if I make 10,000 this year, it'd be awesome. As someone who is just starting out, what is your recommendation for keeping the business separate from my personal? Because I am going to have to prove to both CPP disability and community services a source of income. How do I do that so that it is, I don't pay for it later?
Yeah. Okay. So I hear certain levels of income will have even worse tax implications for you because there'll be clawbacks on other income issued to you. So that comes in the form as a surprise, normally on your tax return too. Social benefits repayments, it's called. So for you, I would just very specifically know what those numbers are. Determine what your goals are. Are your goals not to be in receipt of that funding anymore and be totally self-employed, or are you operating at a level that makes sense for you? I think it's a little bit of like a life conversation, what's going to work best for you, or are you going to go all the way for it?
I'm looking for something to supplement, just because my health is up and down and very unpredictable. I'm looking for something to supplement what I am having already.
So do you know the numbers of what you're allowed to supplement, the amount? You don't have to tell me them, but that's the place you start, is knowing I'm allowed to make $5 additional $1,000 annually. That works out to $550 a month. So revenue minus expenses, you got to keep it separate, have its own bank account. And I know that, you know, when we're starting out, the thought of paying like business bank fees and then bookkeeping and all that stuff is scary. But the only way to prove the separation is to have the separation. And when you're going to be audited because of other income types, it's really important to separate.
So just FYI, with CPP disability, they're saying that they're using the number 5,000 a year.
I knew it was 5,000. That's why I said that.
Yeah. And with income assistance or with community services, if I make over $350 in the month, they start taking percentages back of what they'll give me at the end of the month. So I have to deal with income assistance monthly, and I have to deal with CPP disability yearly.
Right.
So trying to keep it all track.
I got it. My knee-jerk reaction is to see if I would start with sustaining the 350.
Okay.
That's where I would start. Jonah.
My question is, for somebody that makes like a decent salary like I do and has like really low cost of living, if you were to start a corporation and you didn't need the money that the corporation was going to make to live on, because the money that you're already making takes care of your day-to-day expenses in your life, so the company would have like the retained earnings year after year or whatever, would it be like, because I know you said the number was like around 100K, but if you had trying to think of like a low expense business, so like basketball training, if I was to say I wanted to incorporate basketball training and that was going to make 15,000 or 20,000 even in the year, if I didn't need that money to live, is there any benefit to being incorporated as to sole prop, even though it's like a relatively low amount of money?
What a great question. So to summarize, I will say a personal tax dollar is significantly more expensive than a corporate tax dollar. So the margins, tax brackets for corporations, so 0 to 500,000 is somewhere around 16%. So I would only pay on that passive, it's not passive income, it's still active income. Sorry, Jonah. On your basketball training business, if you incorporate it and you leave all that money in and you don't take any out as personal income, it will only be taxed at it's like 16 point something or other percent. And it doesn't hit my personal taxes at all because I didn't take any of that income. While I may have been the person who earned it, my corporation is a separate entity and that income stays separate from me. So I did not receive the money, the business did. So corporate tax dollars are way cheaper, but they're more costly for accounting fees, the process of incorporating, and as well as, you know, just starting out, you don't know really where you're going to end up, where it's going to go. Incorporating isn't always the best route, but for some folks, it's incredibly tax advantageous. Joshua.
Sorry, just before you ask your question, Joshua, I'm just going to jump in. We're going to be a little mindful of time, so we'll make this our last question, but we'll be sharing how you can get in touch with Stephanie after the event.
Thank you. Sorry.
Hi.
Hi.
Hello?
Go ahead, Josh.
Hi. Yes. So I have a restaurant, and we live on the second floor, and I have an apartment on the third floor. So I'm not charging the 15% tax on the rent upstairs
because it's residential. Yeah.
Yes, it's residential. So do I need to put that one on the income?
Yes. So it's still a sale. It's just not an HST, a sales tax eligible. So residential rent is considered tax exempt. Commercial rent is not tax exempt, but that's just sales tax. So it still doesn't mean that you don't pay income tax on those earnings. So you absolutely still need to report the income earned from that residential rent you're charging.
Okay, so let's say if my restaurant is making like 50 grand a month, and then plus 1,500, so it's gonna be like 51,500 on the sales. But my sales tax will be like different.
Yes,
Right.
that's exactly right.
Okay. Second question. Sorry, it should be one. One more, because it's getting complicated because I have a restaurant and I have an apartment. But I already I put already two bank accounts. One for my apartment is Scotiabank, and my restaurant is RBC. So I mean, for the tax purposes for this, I mean, can I put this one in one incorporation? Like,
yeah, so rental income is typically passive income anyways, so it goes on a different tax line, and then your restaurant will go on a Schedule 125 in the corporation, so it'll report the sales and expenses for the restaurant on one section and the rental income on another section, but they're all going on one tax return. Or they can all go on one tax return, I should say, sorry.
okay, so you mean one, because I created a one corporation.
Yeah.
I can put like this apartment and then this restaurant in one corporation, right?
Yes.
Okay. I don't have an accountant, so I think I need to make a schedule for you, because
So,
I'm gonna go crazy now.
very good. Okay, Caitlin, go ahead. Sorry.
No, thank you so much, Stephanie. That was so educational, and I really took a lot away from it. There were so many good tips. I think that's the most sense that taxes have ever made. So thank you so much for sharing your time, and thank you to all of you for joining us today. If you enjoyed today, we have an Ask the Expert series every month on the last Thursday of the month from 1 to 2. Next month, July 27th, we have Debbie Adams talking about money, heritage, and business. So if you're interested, we're going to be sharing the link to our future events. We're going to be sharing how to get in contact with Stephanie, the recording from today, the slides, and some really fantastic resources from Stephanie as well. So thank you all for joining us, and I hope you have a great rest of your day and a great long weekend.
Thank you.
Thank you.